And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
Hi, and welcome to today's edition of Lance Roberts Podcast right here at realinvestmentadvice.com. Thanks for joining us today on this Thursday afternoon. Richard Rosso, certified financial planner, in studio with me today as well. So let's talk a little bit about the markets. We're going to talk about the FIRE strategy, right? This is this financial independence, retire early strategy. It's been making waves here lately. And we're going to be talking a little bit about the reality of doing that. And of course, Richard's going to have some good conversation, I'm sure, and some good comments about the FIRE strategy. You're looking like you don't know what I'm talking about over here.
The only way I'm going to retire early is if I do set myself on fire. I don't really know how this is going to work, but yeah, we'll talk about that. Yes, I do know what it is.
All right, we'll talk about that,
Yes.
and then of course also a little bit about the markets and what's going on today, some other stuff. So hang around, more coming up on the Lance Roberts Show. Let's talk about the markets today because, well, after a brief pop higher on Tuesday, now remember earlier this week we had this big rally in the markets. Everybody was so excited. It was like, wow, man, the bulls are back, and that was a buy the dip opportunity. Well, it turned out really maybe not so much. After the last couple of days of sell-off, the market has now completely reversed that entire pop that we had earlier this week, and we've actually wound up sitting right on the 200-day moving average. Now, this is very important. While today was a big kind of a sell-off day, and again, right now as we wind up the day, market's down well over 300 points on the Dow. S&P down over 30 points right now. So the issue is, though, is we're sitting right on this support that has been really this running moving average that's really kind of gone back here for quite some time. Now, the 200-day moving average has been an area where we violated it in the past, just like we violated it here just a couple of days ago, last week in particular. These dips below the 200-day moving average have now become buying opportunities. Now, I'm not saying buy the dip. I'm just saying that this is the way the 200-day moving average has been treated. Historically, going back through history, violations of the 200-day moving average were generally the beginnings of bigger sell-offs within the market, but not in the last couple of years. Investors have become trained by the Federal Reserve and by central banks to buy these opportunities, buy the dip, because, well, there's always going to be the Fed put. That may not be the case. Earlier this week, Chairman Powell came out and basically made some very hawkish statements about Fed policy, saying simply that, well, they're willing to hike rates above the neutral rate. And what that means is that actually putting interest rates into a position where you're actually constricting monetary policy within the United States. So that is a drag on economic growth. It'll ultimately be a drag on earnings. And of course, it's going to be an impact to the bond market as well because of higher interest rates. But right now, the market's been taking all this pretty much in stride. And while we did sell off here today, again, we are sitting on that pretty important support. Now, as we talked about earlier this week as well, one of the important points is that we are still fairly oversold. What this chart shows you that we're looking at right now is the S&P 500 is the blue line. The yellow is basically an overbought, oversold indicator. I got an email earlier this week. It's like, well, what does that mean? Overbought, oversold. Overbought, oversold is simply a function of looking at the market in terms of buying and selling. When there's a lot of buying going on in the market, ultimately all the people, and this is a very simplistic way to look at it, but basically when everybody has kind of sold what they're going to sell, basically buyers have to go out and bid up prices higher in order to find sellers. And so ultimately we get to a point to where buyers are no longer willing to bid up the price, and that's when markets become overbought. Conversely, when markets get extremely oversold, in other words, all the sellers have now sold and they're not willing to sell at lower prices, that's when markets really get here to these oversold conditions, which is where we are currently. Now, historically speaking, these oversold conditions have been bottoms to the markets. And so when you have these big sell-offs, conditions get very oversold here, and that's typically where we've seen a bounce. Now, just because you're oversold doesn't mean that you're going to get a rally that takes you all the way back to all-time highs. It's possible, but it's not a guarantee. The second thing here is that we did bounce this previous week, so we did work off some of that oversold condition. And think about overbought, oversold is like fuel in a gas tank. So when the car is extremely, or when the market's extremely oversold, the car has a full tank of gas. So you start, heading down the freeway, and ultimately, as the market gets more and more overbought, you're starting to run out of that fuel, that drive to push asset prices higher. Currently, we've still got plenty of fuel in the tank currently to help push this market higher in the next few days, but just because you're oversold doesn't mean you can't stay oversold for a long period of time. So again, just because you're oversold does not mean it's a guaranteed rally from here. And if we stretch this out a little bit and start looking at longer term time frames, this is a weekly chart of the S&P 500. There's a couple of things here importantly. Oversold conditions on a weekly basis, we're extremely oversold. Historically, over the last several years, whenever we've been as oversold as we are now currently in the markets, this has indeed been a decent buying opportunity to put money to work. Why am I telling you this? Am I telling you to buy the market here? Not necessarily. There's some other issues to be concerned with. But what this also means is that you shouldn't panic sell into this decline either, because very likely because of these extreme oversold conditions, you are going to get a bounce. Now, let me talk about a couple of things here. It's important. If this recent sell-off has been bothering you, right? You're up at night, you're worried about your portfolio, you're worried about what's happening within the markets, you're losing sleep, it means you've got too much risk in your equities. And again, it's not uncommon that people have levered up a lot of equity risk because a rising bull market covers up a lot of investing mistakes. We make investments that we probably shouldn't have. We take on more risk than we should have. And what these corrections in the market do is really make us realize just how much risk we've taken on. So use any rally here from this oversold condition to rebalance your portfolio, reduce some of that risk so that you can get your risk tolerance back in line with a portfolio structure that you can live with in the event of higher volatility like we've had so far this year. The second thing here is that on a rally, you definitely want to start taking a look at your portfolio and starting to reduce areas of the market that have been breaking down, not performing well, and rebalance the risk out of things that aren't working and move money into things that are working. And that would be corresponding here with a market that's having a lot more trouble making new highs. Now, I want to point your direction here is that the market's done nothing wrong. While we've had this big sell-off here over the last couple of weeks and volatility has definitely picked up, there's no doubt that price volatility this year, really since January, we've had a big pickup in the volatility of the market. This has not been what we saw over the last couple of years where the markets just kind of went up month after month after month. There's definitely been a pickup in volatility, which has now gotten investors' attention. But the market's done nothing wrong. We're still within a very defined uptrend. So as long as the market can continue to hold these longer-term moving averages, which is what we're sitting on currently, and we close today right at that very critical support level, if we can hold this through Friday, and again, from a portfolio management standpoint, what Richard and I do is it really doesn't matter to us what happens during the middle of the week. It's where we finish up the week that matters. Tomorrow is important that we continue to hold on to this support. I think we will. Don't be surprised if we don't get a rally tomorrow to finish out the week. But again, any rally from here, certainly want to take a look at that in terms of reducing risk, rebalancing portfolios, and potentially hedging yourself against what appears to be potentially a bigger topping process that we may be engaging into heading into 2019. Now, having said that, when we come back from the break, let's talk about FIRE, which is financial independence, retire early. Is it feasible? Is it something you can actually do? And we'll talk about the importance of what it means to actually have the money you need to retire on. That's coming up next on the Lance Roberts Show podcast with Richard Rosso, certified financial planner. Be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.